AFG has re-entered the high conviction list. It last closed at a share price of $1.55, and at that price, it's offering an FY19 dividend yield of 7.4% fully franked. It's also offering some decent growth, so we're looking for EPS CAGR of 8% over the next 3 years. Now, there's still plenty of concern about regulatory risk for broker remuneration models, and as well as concerns about what a cooling housing market might mean for AFG. We think those concerns are being overplayed. So on reg risk, I mean, I'd refer you to the deep dive that we put out a couple of weeks ago, but on reg risk, it looks like the proposal of a fee-based REM model is all but dead, particularly based on the Productivity Commission's final report. Now, while the Productivity Commission did recommend that trail commissions be banned, we're not expecting Treasury to take up that recommendation, and that's at least our read of Treasury's submission to the Royal Commission. It does look like of all the remuneration model options available, it looks like Treasury is most comfortable with the standard commission model with SIF changes adopted. On the housing market, look, if things do start to go very sour, and if that starts to hamper AFG's organic growth, AFG does have a very strong cash position at the moment, and their cash flow generation continues to be strong. So they're sitting on, I estimate, around $60 million of unrestricted cash at the moment. And so if the organic growth does get hampered, they can use that cash to generate acquisitive growth by going out there and acquiring smaller aggregators. Now, in an environment where their organic growth is being hampered, you can imagine that they would be able to pick up or acquire the smaller aggregators at a very, very good price, very cheap price. So I think there is a plan B there if things go south in terms of organic growth. The one thing that I will point out, just back on the reg risk, is that we're expecting the Royal Commission interim report to be well, it should be finalised and handed to the government by the 30th of September. In terms of when it's publicly released, it would be thereabouts or shortly thereafter. Now, that interim report, what the Royal Commission has indicated so far, that interim report will talk about key policy-related issues relating to the first 4 rounds of public hearings. Now, so brokers are likely to get a mention in that, because brokers were covered off in round one of the public hearings. So the only hearings that won't be covered by the interim report will be round 5 and 6, which were superannuation and insurance. So look, the mention of the broking industry is likely to feature in that interim report. That's not worrying me, again, because when I take a look at ASIC's current position, the Productivity's current position, and Treasury's position, it's when I connect all those dots together, that it looks increasingly like the standard commission model with SIF changes is here to stay. And just to remind you that the Royal Commission has been considering the merits of the combined industry forum changes that are being proposed for the standard commission model. So it's not like the Royal Commission has in any way written off the standard commission model.